Well, it gives me extraordinary pleasure to bring on board the one and only Chris Woods of Jefferies, someone who I've always admired for his ability to predict cycles, connect global dots with technical trends, and then when it comes to India, while Chris has been a long India bull, irrespective of what is happening in the world, Chris has always maintained that structurally and cyclically, India is one of the best stories where you should always stay invested. Chris, welcome to India. It's so nice to meet you. Feels like life is normal now. I'm meeting you after almost three and a half years.
Yeah, nearly. This is my first trip for more than 2.5 years to India and the Kunj.
Yeah, feels so nice to meet you again.
Thank you.
It's not, if you're an equity investor, it's not a nice feeling. Whether it is global developed market equities or Indian markets equities or emerging market equities. Are we reaching that point of maximum pessimism?
No, I don't. I think the real monetary stock market shakeout has been in the US, which makes sense because it's the US where the monetary tightening dynamic is really kicking in, and it's the US which had the highest valuations, particularly in the whole tech space. So to me, no, we have not reached a moment of maximum pessimism. What's happening in the US is the sell-offs going from the periphery to the core. We've had very massive sell-offs in the profitless thematic tech segment. In the biotech stocks, what's happening now is we're going into the mainstream. So the market leaders like the FANGs are starting to have significant corrections. And we will probably only reach maximum sell-off when we get much more redemptions out of the ETFs, not redemptions, outflows out of the ETFs.
So when you say that we've not reached the point of maximum pessimism, what indicator are you using for benchmarking purposes? Valuations, dollar index, flows, technicals?
Well, no, the valuations are so extreme in the US that, that they can definitely, you can get more valuation compression. No, I'm looking to see whether we get big outflows out of ETFs. So in the first 3 months of this year, there were no outflows out of domestic US equity ETFs. Those outflows only really began in the month of April.
So has a bear market started for global equities?
Well, no, bear market, well, whether you call it a bear market or correction, it's clearly well underway, but the S&P is not yet down 20% from the peak. Wouldn't surprise if it goes down 30% from the peak.
How different is the current market situation from what we saw, let's say, in the previous cycles? 2000, before the meltdown in TMT stocks, 2008, before the meltdown in financials.
Oh, no, the big difference right now is being triggered by monetary tightening in an environment where the Fed is perceived to be behind the curve and is trying to play catch up, having failed to understand that there was going to be a big surge in inflation as a result of the massive money printing which got underway in America in response to the pandemic back in the spring of 2020. So this inflation surge we see in America and in other G7 countries last year is the consequence of the money printing we had in 2020.
So if you have to crystallize the way how in the near term inflation would move, at 8%, I'm reading your notes also, they are talking about the fact that US inflation is about to hit its peak.
It may be, but the real issue is where it settles. So there's a good chance inflation may have statistically peaked. That would be a clearer cut story if we didn't have this Ukraine conflict going on. So before the Ukraine conflict broke out, I think it was pretty clear inflation was likely to peak in the March data point announced in April. But for now, it's much less clear. And the ultimate issue, how much inflation comes down or not, will depend on how much the Fed ends up really tightening.
Do you think Fed will over-tighten?
Over-tighten from what perspective?
Well, they can be ahead of the curve, which is that you start with 25, you've done a 50, another 50 is coming, but instead of 50, they may do 75.
No, I don't think they'll do 75, but the key issue is how long does it go on for? So to me, the most important issue in financial markets this year is does the Fed execute another U-turn, or does its language significantly change throughout the course of the year?
So how should investors protect their portfolio in this kind of an environment? Because there is a risk off in just about every asset class. Bonds are a poor investment to make, but equities are selling off, Bitcoin is selling off, just about everything is going through this process of risk adjustment.
Yeah, but the cyclical value equities have outperformed significantly year to date. So anybody who invested in the cyclical value stocks would have definitely protected themselves. But what's interesting this year, as you rightly say, is the government bond prices have been going down at the same time as the stocks. And that's a different development. And that means there's positive correlation on the downside in equities and bonds. And that means people who own bonds as a diversification away from equity risk have been badly disappointed, particularly in the developed world.
So,
But my favorite sector remains what it was last year, and that's energy stocks.
do you think this transition from growth to value or from growth to cyclical, is this a multi-year transition? Could be a decadal trend?
It will be a multi-year transition if the Fed doesn't break the back of inflation. So
Right.
that will depend on how hawkish the Fed really tends to be. The Fed is talking extremely hawkish. If the Fed really tightens by the degree it's talking about, and we have real significant balance sheet contraction, the Fed can definitely break the back of inflation. But my personal base case is, there will be sufficient financial collateral damage that at some point the Fed will back off before they really break inflation.
If inflation, if central banks currently are trying to break the back of inflation, and which central bank inflation is suddenly the public enemy number one, is it a good time to invest in energy and commodities?
There's a good reason to invest. The reason to be invested in energy stocks is because there's a hedge. Because there's a hedge on the rest of your portfolio, because there's a significant risk that oil goes to $150 or higher. So I was concerned. I thought oil could go to $150 even before the Ukraine conflict broke out.
Chris Wood has this reputation that he loves India, and over the years you've demonstrated that with your thoughts, with your research paper, and with your newsletter. But strangely enough, your current India holding is a mild overweight.
Yeah.
In the past, you had run portfolio recommendations or model portfolio recommendations where India was a significant overweight. Why is that?
Well, no, because India, in the short term, the RBI has begun a tightening cycle, and my guess there could be 2 more rate hikes in the next 2 meetings. I'm concerned about higher oil prices. So actually, I've been surprised how resilient the Indian market has been so far this year. We've had big foreign selling, but that's been more than absorbed by very impressive domestic inflows. But tactically, yes, I think in the short term, we're still at risk of more downside in India. So my base case would be to raise the Indian allocation materially if we get more of a correction.
And can you define correction for us? 5%, 10%?
No, so most people here seem to look at the Nifty more than the Sensex. So if we got to 14.5 on the Nifty, then I would definitely be raising the Indian weighting. Of course, we've got a tactical risk short term, clearly monetary tightening, the oil price. Also, the food inflation has obviously been aggravated by the Ukraine situation. But in the big picture, the good news in India is that we finally saw evidence of the residential property cycle turning up last year after a 7-year downturn. That's very important because that's a multiplier for the whole economy. And my base case is the residential cycle can run for as long as the last down cycle went on, which is 7 years. That was a positive employment generation. And I'm still of the view that hopefully once this various shocks are out of the system, we can move into a broader capex cycle. And so I'm looking at India as being in a similar macroeconomic situation as where we were in 2003, which is the last time India entered an upturn in the residential property cycle.
And I distinctly remember reports in 2003, you did mention that why Indian real estate stocks would do well. And I'm not surprised that in your current long-only portfolio, there is a Godrej Properties, there is a Century Textiles, and there is a DLF.
Yeah, well, I could have other names too. So but I'm running this as a structural portfolio. tactically, if I was running the portfolio for 3 months, it would be look a bit different.
And how different would that 3-month portfolio
Would it be more defensive?
When you say defensive, it's a combination of consumers, IT.
Well,
and
you
pharma.
wouldn't have rate-sensitive stocks in a short-term view because the Fed's rate. I mean, the RBI is raising rates, but the monetary tightening cycle in India is nothing like what you're potentially seeing in America.
I'm going to ask a very simple question. Perhaps this is the most important question. Is the Indian bull market over, or this is a typical hard and a strong bull market correction?
Oh no, in India this would be a bull market correction.
For those who bought the COVID fear, May 2020, they're feeling happy. For those,
oh yes, we bought the yes.
for those who bought the fear, 6 months from now, do you think the May sell-off of 2022, in hindsight, will be the biggest time when you should be buying?
No, I know. I do think that absolutely. Not the. Actually, so far this year, the Indian market's been remarkably resilient, and if these domestic flows, which are very impressive, continue, then the foreigners will be surprised and will have to come back in at higher levels than they anticipate.
But Chris, let's look at the lay of the land around us. Russia, nobody will invest. China, own set of challenges. You got emerging market currencies which are a challenge for markets like Turkey. So frankly, I'm not speaking like a patriot, but if I look like a realist market commentator, India seems to be the best large investable market with this kind of an underlying growth. So
That's right. That's absolutely right. So
then why are foreigners selling?
no foreigners have only sold a very small amount of their total holdings. So this is not a big deal. The foreigners sold at the beginning of this year for very few simple reasons. India was at the top end of the valuation range. They knew the RBI would have to start tightening. The Fed was starting to tighten. There is this material oil price risk. All these were reasons to reduce, but they also sold because they put more money into China. And they put more money into China for, at the time, seeming perfectly logical reasons. The Chinese have begun to ease monetary policy after being tightening. So China's in a different cycle from the Fed. China eased fiscal policy, eased property on its property market. So people put money into China. But obviously that investment in China has backfired because of the extreme lockdowns, which have really hit the Chinese economy and the Chinese stock market badly.
What could be the turning point for the market, Chris? Because markets will turn, either there is a change in terms of the news environment or valuations have to become attractive. I'm just putting this question for the benefit of our viewers so that they can relate to it.
So yes, so the valuation's already down from what they were. So I think if we have 2 more rate hikes in India, then maybe, then people will begin to hope that the monetary tightening cycle's over.
Why is that I don't see any IT in your portfolio?
No, because my portfolio is domestic demand driven.
Are you bearish on the global demand?
No, I never had IT in my portfolio. So look, Indian fund managers have definitely gone into IT because in the recent months, because they didn't want to be in interest rate sensitive sectors, and that's worked. But right now, with global demand concerns rising and with the tech stocks correcting sharply, the IT services companies will be at risk of derating, in my view.
Chris, the mix of your portfolio this time is very interesting. You own a Jubilant FoodWorks, expensive, based on historical parameters and P multiples. And you also have ONGC. It's a classic play on energy.
No, I have energy stocks simply to hedge the risk of a much higher oil price.
Okay, so that but why is oil sustaining above $100 if China is slowing down?
Because there's no supply of oil, because of the unintended consequences. Well, not actually, I shouldn't say unintended, of the intended consequences of the political attack on fossil fuels in the Western world for the last several years, which has been gathering momentum and has its equivalent in the investment world in the ESG space, has meant that the fossil fuel industry has been disincentivized in the last 5 years or more to invest in oil and gas, which means we have a massive supply constraint, which means if oil goes up in price, you won't get a supply response.
Dollar is, or the dollar index, if I may use that benchmark for illustrative purposes, is at a multi-year high, and one would imagine that US inflation is high, US economy is slowing down, interest rates are moving higher, the dollar should actually be weak.
No, because the market's looking at more rate hikes. And the real dollar strength actually has not been against emerging market currencies, it's been against the yen and the euro.
Is there a fear of recession in the world?
Well, no, that fear will grow as the Fed tightens. But that fear will grow. But in the short term, the concerns about recession are much more marked in Europe than America.
This shakeout, when world is adjusting to the risk, what will emerge stronger, what will become weaker, and what will get completely washed out?
What do you mean in what sense?
Which, like India is going to emerge stronger. What do you think will get hurt the most when risk is adjusting?
No, I'm not sure. I'm not clear on that. No, I think the European economies are most vulnerable in the short term. US economy, in my view, will be resilient for longer. There's been a lot of wage gains in America, particularly at the lower end of the labor market. So maybe weakness doesn't really show up before later in this year. But one issue for the US economy will be the wealth effect in the stock market if this correction continues, because American households have a lot of money in equities.
Over the years, you've written and you've spoken freely about gold. It's for the first time that inflation is going higher and gold has not gone higher. Why is that?
Yeah, no, gold was very disappointing last year. You had very negative rates. This year, actually, gold's been behaving better. You have a very hawkish Fed, monetary tightening expectations rising, but actually gold has actually behaved okay, and you've begun to have ETF flows in America into gold. So to me, gold will get a real bid if the Fed does a U-turn at some point. And the Fed turns out not to be as hawkish as it's currently talking.
Can India do what Japan did in 1980s, moved independent of the world, what China did between 2000 to 2010? Does this decade belong to India?
No, there's no reason why India can't do that.
Why do you think it will do like that?
No, there's no reason why it cannot do that.
Okay.
And to an extent, yeah, and so that's why it's important the residential property cycle's kicking in, because that's a domestically driven sector that generates employment in the construction sector, that has all kinds of multiplier consequences. And the affordability is there because for 7 years, I would assume, nominal income growth in India has run well ahead of property prices.
Won't high interest rates, which is what will happen because of high inflation, spoil the
No, but the interest
party?
rates aren't that high relative to history in India. Because people are used to high interest rates here. So actually interest rates are quite low.
Over the years, Chris, every time inflation has come back, it is important to buy companies which give you pricing power. It is important to buy hard assets. We've not seen inflation in last 10 years. Do you think that global investors now will have to change their mindset?
No, but in the Western world, you haven't seen inflation since the late 70s.
Of course. The first time they're experiencing an inflation shock.
40 years. 40 years, obviously in India. So that's why there's a real significant possibility in a regime change where value cyclical stocks will have an appeal for longer, not just for a short-term trade.
So, Chris, what is the future for FANG stocks?
The FANG stocks will correct more.
And if FANG's correct, since that's...
Well, they are correcting. They're in the middle of a correction. There's a chart in my green and fear. So we're in the midst of a FANG correction, which is what I mean for the periphery going to the core. But maybe if the S&P is down 30%, maybe that correction will be done. But an S&P down 30% will start to put pressure on the Fed, in my view, to slow down the tightening, because there will be much more concern about the wealth effect. And then the political pressure from the Biden administration on the Fed to tighten might start to change. Because the important point to understand is for the first time since the 70s, in the last few months, there's been political pressure on the Fed from Washington to tighten. This is something very unusual.
When China opens up, right now they are going through an extreme COVID lockdown. Will demand unleash, and could there be a greater push to inflation?
No, there won't be inflation. When China opens up, they're going to be doing more stimulus. and that will be positive for commodities. The problem right now is there's no sign of China opening up. And that's actually good for India, because that's the oil price today, in my view, would be materially higher if the Chinese economy was fully opened. So in that sense, President Xi is doing India a favor.
So Chris, just to wrap it up, two more last questions. I'll not extend my appointment with you beyond that. And I don't want to get this one wrong. If I summarize by saying that Chris Wood feels that in next 3 to 6 months, markets will remain volatile, but in next 12 to 18 months or next 18 to 36 months, this is a time when you should actually be building the portfolio.
No, to me, this is the next few months are, a time when you should be trying to add to your favorite stocks on weakness.
And you remain...
And actually, then the surprise to me, frankly, is there hasn't been more of a correction in India as of today.
Do you see that happening?
Well, my base case is, but I would have said the same thing at the beginning of January. And the reason there hasn't been more of a correction is because of the strength of the domestic flows.
You liked banks in the past, and you still like banks right now, whether it's a combination of ICICI Bank or HDFC Limited and Bajaj Finance. Why are you so excited about owning banks? Because
no, that's just a structural story. There's nothing.
You still feel that in a rising interest rate environment, banks will do well?
Yeah, but if you were managing on a very short-term basis, that wouldn't be your favorite sector.
I'm sure when you write your strategy note, some of your peers must be writing back saying, Chris, what makes you so bullish on India? Because you, in a sense, over the years, are one equity strategist who's not changed his view on India. I've read so many reports in the last 20 years where equity strategists, they've become from bullish to bearish and bearish to bullish and bullish to bearish.
Yeah.
You've been an evergreen India bull.
Well, no, but actually I think what's really interesting about India right now is not the economy, it's the growing evidence of an equity culture amongst the Indian investment community. And you see that in these flows into the domestic mutual funds. And you have the installment scheme, but to me there's clearly an emerging equity culture which is interested in investing in growth and growth stocks. This is actually quite unusual in emerging markets. So I think that is a big, very positive development.
When you received the letter from the Prime Minister of India, where he in a sense said thank you for endorsing India over the years, what was your first reaction?
Oh, well, I was very honored.
Well, such a pleasure and such an honor to have you back in India. Thank you for joining us, and I always look forward to interactions. And thank you for joining us in our studio in Mumbai this time.
Thank you, Nikunj. Very, very good.
Thank you very much.